Good evening. Let's start with something that's rarely said out loud, the narrative we've held around gold for centuries as the ultimate store of value is under serious threat. In 2025, that narrative is starting to unravel, and it's not because investors suddenly turned away from tradition. It's because the fundamentals have shifted. Gold has always carried with it a unique psychological and historical weight. It has been associated with wealth, safety, and power for thousands of years, and because of that, it continues to hold a special place in the minds of investors. Yet when you step back from the emotion and mythology surrounding gold, what you're left with is an asset that doesn't generate income, doesn't create value, and doesn't contribute to productivity. It just sits there unchanged, waiting for market sentiment to push its price higher or lower. That fundamental quality is what places gold under pressure, especially when global financial dynamics evolve in ways that reward productive or yield-bearing assets. The central issue is that gold is inert in economic terms. Stocks represent ownership in companies that generate profits, innovate, expand, and adapt. Bonds provide interest payments backed by governments or corporations, offering a stream of income. Even real estate can generate rental yields while appreciating in value over time. Gold does none of that. Its entire investment case relies on the assumption that people will want to hold it in the future for the same reasons they've held it in the past. That assumption becomes fragile when other assets offer superior risk-adjusted returns and when the costs of holding a non-productive metal become harder to justify. Opportunity cost is at the heart of this problem. When interest rates are low or real yields are negative, gold has historically looked appealing because it doesn't lag behind much. Everything else also looks unattractive. Investors are willing to hold it as a store of value under those conditions. But when real yields rise, when you can park your money in a bond or other low-risk asset and get a reliable return, that same gold looks increasingly expensive to own. It's not only about what gold does, but about what it fails to do in comparison with alternatives. A 4% yield on treasury bonds or even inflation-linked securities quickly outshines the zero yield of gold, especially when economic uncertainty doesn't reach the catastrophic levels that gold's strongest narratives depend on. Another layer of pressure comes from the evolution of financial systems and technology. Today, investors have more tools and hedges than at any other point in history. Inflation can be hedged with a variety of instruments beyond just gold. Currency risk can be addressed through more sophisticated means. Even the rise of digital assets, which some view as a new form of digital gold, competes with the traditional metal in attracting a younger, tech-savvy generation of investors. The story of gold as the only reliable safe haven weakens when alternatives proliferate and adapt faster than it can. Gold, by nature, doesn't evolve, it remains static, and that's both its charm and its weakness. Psychology also plays a crucial role. Gold is often bought on fear of inflation, fear of fiat debasement, fear of systemic collapse. While fear is a powerful motivator, it doesn't sustain itself indefinitely. Markets move in cycles, and when fear recedes, so too does demand for gold. Meanwhile, assets tied to growth and innovation benefit from optimism and expansion, creating compounding returns that leave gold behind over the long term. In that sense, gold's best days are usually linked to moments of extreme pessimism, and if those moments don't materialize as expected, its lack of productivity becomes a glaring disadvantage. There's also the cost of carry. Unlike productive assets that generate cash flow, Gold requires storage, insurance, and security. These hidden costs eat into its appeal over time. When compared to assets that not only protect purchasing power but also generate income, the logic of holding a large allocation to gold starts to erode. Its value rests heavily on perception, and perception is a fragile foundation when structural shifts are taking place in the global economy. The key point is that gold's narrative depends on belief. It doesn't adapt to changing environments on its own. It's investors who adjust their faith in it. And in an era where capital chases productivity, where opportunity costs are rising, and where alternatives are multiplying, gold's lack of inherent productivity leaves it exposed. This doesn't mean gold will suddenly collapse or lose all value. It means its role as a dominant hedge, as a cornerstone of wealth preservation, is increasingly contested. When push comes to shove, investors often prefer assets that both protect and grow wealth, not just preserve it passively. That imbalance is what puts gold under pressure, and it's why relying solely on it in a fast-changing financial world may prove to be a costly miscalculation. When evaluating the place of gold in a portfolio, one of the most important forces shaping its future is the concept of opportunity cost. Opportunity cost is simply what you give up by choosing one investment over another. Gold, by its very nature, does not provide a yield. It doesn't pay interest, dividends, or any form of recurring income. It is a static asset valued primarily by the perception of safety and scarcity. That static nature becomes a serious drawback when the investment environment offers more attractive alternatives that generate steady, reliable returns. The higher those alternatives rise in attractiveness, the greater the pressure on gold's role and price. In environments where interest rates are near zero, or when inflation is running high enough that real yields adjusted for inflation turn negative, holding gold seems reasonable. If your money in a savings account or government bond is effectively losing purchasing power after inflation, gold can look like a defensive option. Investors in such times are more willing to accept the zero yield of gold because the alternatives look just as bad or worse. But this equation changes dramatically when central banks raise interest rates, when real yields move into positive territory, and when assets such as treasury bonds, high-quality corporate debt, or inflation-linked securities begin to offer meaningful returns. Suddenly, the trade-off becomes obvious. Why sit on an asset that generates nothing when others offer income, safety, and liquidity? This shift in yield dynamics directly undermines one of gold's main appeals. The metal may hold its value when currencies weaken or when financial systems face stress. But outside of those moments, it has to compete with assets that not only preserve wealth, but also grow it. Investors with long-time horizons, especially institutional ones managing pensions, endowments, or sovereign wealth funds, cannot afford to allocate large sums to something that doesn't produce cash flow when viable, lower-risk alternatives exist. That's where the rising opportunity cost becomes most visible. Capital tends to flow toward what is productive and away from what is static. History provides clear examples of this. During periods of rising interest rates, gold has often underperformed because the cost of holding a zero-yield asset grows more pronounced. In contrast, when real interest rates fall or remain negative, gold typically benefits. This seesaw effect is not just coincidence. It's a direct result of investors weighing the opportunity costs. Every dollar locked into gold is a dollar not earning yield elsewhere. When yields are unattractive, that trade-off is easy to justify. When yields climb, the justification weakens rapidly. There's also the matter of investor psychology. Most participants in markets seek not only preservation, but also growth. Assets like bonds, equities, and even real estate provide a sense of participation in the productive economy. They generate income streams and can compound over time. Gold does not compound, it is inert. That psychological weight tilts even further against gold when the visible, predictable returns of other assets become more compelling. Investors may tolerate holding a defensive, non-productive metal during crises or in anticipation of inflation, but their patience erodes when they see steady returns elsewhere. The shift doesn't need to be dramatic. Even a modest rise in yields can be enough to reduce gold's relative appeal. Another dimension comes from innovation in financial markets. Today, there are many alternatives that can play roles traditionally attributed to gold, but with added advantages. Inflation, linked bonds, structured products, and even new digital assets provide ways to hedge risk while still offering income or participation in broader financial ecosystems. These instruments chip away at the narrative that gold is the singular safe haven. If you can hedge inflation and currency debasement while still collecting interest, the logic of holding an inert metal weakens. Gold becomes the less efficient choice, and in markets, inefficiency eventually gets punished as capital seeks optimization. This doesn't mean gold has no role at all. It can still act as a psychological anchor, a hedge against tail risks, and a diversification tool. But in a world where interest-bearing assets become more appealing, that role shrinks. Investors rarely think in absolute terms, they think in relative ones. It is not enough for gold to simply hold its value. It has to justify its place against alternatives that are dynamic and rewarding. And as yields rise, the relative equation tilts decisively against it. The rising opportunity costs are not just a temporary cycle. They reflect a deeper reality of capital allocation. Money gravitates toward assets that work while you sleep, that generate streams of income, and that grow in value through participation in productive systems. Gold does none of that. The more attractive alternatives become, the more the spotlight exposes gold's limitations. What once seemed like a timeless safe haven begins to feel like a costly luxury, not because it vanishes in value, but because it fails to keep up with evolving opportunities. That gap, the widening spread between yield alternatives and gold's inert nature, is what makes its future role so precarious. One of the strongest arguments for holding gold has always been its role as a diversifier. For decades, investors believed that gold provided protection when other assets fell, particularly equities. The idea was that gold had a low or even negative correlation to traditional investments, meaning it could offset losses in periods of stress. That logic has guided countless portfolio strategies, and for a long time it seemed valid. But correlations are not fixed. They shift with time, policy, and macroeconomic forces. When those correlations start to break down, the diversification argument for gold becomes far less reliable. This breakdown is not theoretical. It has already been observed in several market cycles, and it points to a structural risk that may intensify in the years ahead. The assumption that gold always moves in the opposite direction of risk assets is an oversimplification. In truth, correlations vary depending on the environment. In certain crises, gold has risen while equities have fallen, supporting its reputation as a safe haven. In others, however, gold has fallen alongside equities as investors rushed to raise cash, sell liquid assets, and cover margin calls. During the 2008 financial crisis, for example, gold initially dropped sharply as part of the broader liquidation before recovering later. More recently, in the March 2020 pandemic crash, gold also declined during the worst days of panic because investors needed immediate liquidity. These episodes reveal that gold's diversification benefit is conditional, not absolute. The deeper issue is what happens when macroeconomic factors drive correlations across the entire financial system upward. In times of stress, central bank actions, shifts in liquidity, or changes in investor psychology can cause many assets to move in the same direction, reducing the effectiveness of diversification. Gold, despite its reputation, is not immune to this convergence. If investors begin to view it as just another tradable asset rather than a unique store of value, it can start behaving more like the rest of the portfolio. This is particularly true in a world where financial markets are more interconnected and leveraged than ever before. When liquidity dries up, even so-called safe havens can get pulled into the selling wave. Another factor undermining gold's diversification case is the evolution of alternative hedges. In the past, gold was one of the few assets considered a hedge against systemic risks and inflation. Now, investors have tools such as inflation, protected bonds, derivatives, and even digital assets, each of which can absorb capital flows during times of uncertainty. As these alternatives gain traction, gold's correlation patterns may shift simply because it is no longer the singular safe haven it once was. Capital that might have flowed automatically into gold during stress can now disperse into other instruments, weakening its role as the portfolio anchor of last resort. It is also important to recognize the cyclical nature of correlations. In prolonged bull markets, gold often lags as risk assets rise, creating a seemingly negative correlation. But when the cycle turns, correlations can flip quickly. If rising interest rates or deflationary pressures dominate, gold can fall right alongside equities and bonds, leaving investors without the safety net they expected. The illusion of diversification is particularly dangerous because it creates overconfidence. Investors who rely too heavily on gold as a hedge may find themselves exposed at the exact moment they thought they were protected. The danger is not just financial, but psychological. Diversification is supposed to reduce stress and volatility, giving investors confidence to weather downturns. If gold fails to deliver that diversification when it's most needed, the disappointment can be greater than the actual financial loss. It undermines trust in the strategy and forces investors to reconsider the very foundations of their portfolios. In this sense, the breakdown of gold's diversification role is not just about numbers. It's about the erosion of faith in one of the most deeply rooted narratives in investing. Looking forward, the probability of correlation breakdowns is increasing. Global markets are more synchronized due to technology, policy coordination, and the dominance of large institutional flows. When shocks occur, they tend to ripple through every asset class with incredible speed. In such an environment, no single hedge can be relied upon to always move independently. Gold, being highly liquid and widely held, is often one of the first assets to be sold when liquidity is scarce. This makes it vulnerable to acting in concert with the very markets it is meant to hedge. The result is a paradox. Investors hold gold because they believe it will diversify risk, yet in the most extreme moments, the times when diversification matters most, gold has shown it can fail. The more interconnected the global financial system becomes, the more likely that failure becomes recurring. Relying on gold alone for diversification is not only insufficient, but potentially misleading. In the end, the real protection comes not from a single asset, but from building portfolios that combine many uncorrelated return streams. If that structure is absent, depending too heavily on gold for diversification may prove to be an illusion, leaving investors exposed at the worst possible time. For centuries, one of the strongest arguments for holding gold has been its role as a hedge against currency debasement. When governments printed too much money, when fiscal deficits spiraled, or when inflation eroded purchasing power, gold was seen as the timeless protector of wealth. It has no central issuer, cannot be created at will, and carries a history of functioning as money long before modern currencies existed. Yet while this narrative has truth to it, the world today is not the same as it was in past inflationary or crisis periods. Structural shifts in the way monetary systems operate, how policymakers respond to crises, and what alternatives are available to investors are muting the effectiveness of gold as the singular hedge against debasement. The assumption that gold will automatically fulfill that role in every environment is no longer as reliable as it once was. Modern central banks now have a far more extensive set of tools than they did in previous generations. In the past, inflation often spun out of control because policymakers lacked the instruments to contain it. Today, interest rate adjustments, forward guidance, quantitative tightening, and even unconventional measures like yield curve control provide mechanisms to influence inflation expectations and currency stability. These tools don't always succeed perfectly, but they can moderate the extremes in ways that reduce the urgency of fleeing into gold. Investors can now hedge inflation directly through assets like Treasury inflation, protected securities, tips, or similar products, giving them alternatives that didn't exist decades ago. Gold no longer holds a monopoly on protection against money printing. There is also a growing complexity in global capital flows. In a highly interconnected world, currency debasement in one country doesn't necessarily lead to universal loss of confidence in money as a whole. If the U.S. dollar weakens, for instance, investors often rotate into other fiat currencies such as the euro, yen, or Swiss franc rather than defaulting to gold. Exchange rates and cross-border capital mobility create buffers that spread the effects of debasement more widely across markets. This structural evolution reduces the binary choice between gold and collapsing paper money that dominated thinking in earlier eras. Another structural shift is the gradual emergence of digital currencies. While still evolving, central bank digital currencies, CBDCs, and decentralized alternatives have introduced new forms of money that compete for trust in ways gold never had to face before. Younger generations of investors, less tied to the legacy of gold as money, may increasingly view digital assets as a modern equivalent of a debasement hedge. Even if these assets carry volatility, their technological flexibility and integration into financial systems create a sense of adaptability that gold lacks. Every new competitor dilutes gold's role as the automatic go-to asset when fiat systems wobble. The psychological element of debasement hedging has also changed. In the 1970s, runaway inflation and the collapse of the Bretton Woods system created a profound sense of uncertainty, propelling gold to the forefront as a hedge. But in more recent episodes of currency weakness, such as after the global financial crisis or during pandemic-related stimulus, gold has risen less dramatically relative to the scale of money creation. Investors today are more conditioned to believe in central bank interventions, more willing to use financial products as hedges, and more diversified in their responses. This diluted reflex weakens gold's singular status as the hedge of choice. Furthermore, gold's effectiveness as a debasement hedge is highly time dependent. It tends to perform well in sudden, sharp bouts of inflation or currency crisis, but can languish during long, grinding periods where inflation is elevated yet stable. In those scenarios, other assets, real estate, commodities, equities with pricing power, often do a better job of preserving and even growing purchasing power. Gold may hold value, but holding value is not the same as increasing wealth. Over the span of years, the difference becomes crucial. Investors who depend solely on gold for protection may discover that while their wealth hasn't evaporated, it has failed to keep pace with opportunities elsewhere. Another overlooked factor is central bank participation itself. While many central banks hold gold as part of their reserves, their behavior is not uniform. Some add to their holdings as a diversification measure, but others reduce or stagnate their positions. If confidence in fiat were truly collapsing, one would expect coordinated, aggressive central bank accumulation of gold. But the reality is more nuanced. Their diversified approaches reflect the same logic that applies to private investors. Gold is a piece of the puzzle, but not the puzzle itself. Taken together, these structural shifts mean that gold's role as a hedge against debasement has become muted, not eliminated but significantly diminished. It is no longer the only tool available, nor the most efficient in every environment. Believing that gold alone can shield against the complex, globalized nature of modern currency and monetary policy may be more nostalgia than strategy. The world has changed, financial markets have evolved, and hedges have multiplied. Gold still carries weight as a symbolic and practical store of value, but in the face of structural transformations, its power to act as the singular defense against currency debasement is far weaker than many assume. The instinct to search for a single hedge, a single asset that can protect wealth in all environments, is deeply human. It comes from the desire for simplicity, for clarity, and for certainty in an uncertain world. For centuries, gold has played that role in the collective imagination. It was the hedge against inflation, against debasement, against crisis. Yet reality has shown time and again that relying too heavily on one asset is dangerous. The world is complex, markets are dynamic, and risks come in many different forms. A truly resilient approach does not lean on a single hedge, but instead builds a balanced strategy designed to withstand different kinds of weather. Whether that weather is economic growth, inflation, deflation, or geopolitical turmoil. One of the fundamental truths about markets is that no one can predict the future with complete accuracy. At best, one can identify probabilities and prepare for different scenarios. If the future is uncertain, the most rational strategy is to avoid overconcentration and instead construct a portfolio that performs reasonably well no matter what happens. This is the essence of balance. It means distributing risk across multiple assets that respond differently to different conditions. Stocks may thrive during periods of growth, but suffer during recessions. Bonds may do well in deflationary environments, but lose value when inflation rises. Commodities may spike when supply shocks occur but languish during periods of oversupply. Gold may shine during moments of fear but struggle when confidence returns. By holding a thoughtful mix of these assets, an investor can smooth out the extremes and reduce reliance on any single outcome. The danger of relying on a single hedge like gold is that it works only in specific circumstances. Gold may protect wealth during periods of high inflation or when fiat currencies are under pressure, but it offers little defense in a deflationary downturn where bonds or cash outperform. Similarly, it may provide diversification during certain crises but fail in others, as seen when correlations converge during global liquidity crunches. A strategy that assumes gold is the answer to every problem is not a strategy at all. It is a bet on one type of risk dominating all others. History shows that risks come in waves and they rarely arrive in predictable patterns. A balanced all-weather approach acknowledges that every asset has strengths and weaknesses. The key is not to avoid weakness altogether, but to combine assets in such a way that one's weakness is offset by another's strength. When equities suffer, government bonds may provide relief. When inflation eats away at fixed income, commodities or inflation-linked securities may step in. When uncertainty and fear dominate, gold may play its role. The interplay between these pieces creates resilience. Instead of placing blind faith in one asset, the investor builds a system that adapts to whatever the environment brings. Risk management is another crucial part of this framework. A portfolio that is heavily concentrated in one asset may appear strong when that asset is performing well, but it is extremely vulnerable when conditions turn. Diversification spreads risk, but balance takes it a step further by ensuring that no single asset dominates the portfolio's behavior. This means considering not just allocations by capital, but allocations by risk. Assets that are more volatile or sensitive to certain factors may require smaller weightings to avoid overwhelming the portfolio. The goal is not maximum return at all costs, but sustainable, steady performance across different scenarios. The psychological benefits of a balanced strategy are also significant. Investors often make mistakes when emotions take overselling in panic, chasing momentum, or overcommitting to what worked most recently. A portfolio designed to weather different conditions reduces the temptation to react impulsively. It provides a sense of stability and discipline, which are just as important as the mechanics of allocation. Knowing that one's wealth is not entirely dependent on a single hedge provides confidence that endures even in turbulent times. The modern world makes balance even more essential. Globalization, technological disruption, and policy intervention create new risks and amplify existing ones. No single asset can capture all these dynamics. A portfolio that leans exclusively on gold, stocks, or bonds risks being blindsided by unexpected shifts. Balance is not about eliminating uncertainty. It is about building enough adaptability into the system so that uncertainty does not destroy it. In the end, the belief in a single hedge is comforting but misleading. The truth is that resilience comes from combining many uncorrelated streams of return, each playing a different role in the overall system. Gold can be part of that system, but it is not the system itself. A balanced, all-weather approach, one that recognizes the limits of prediction, spreads risk intelligently, and embraces adaptability, is the only way to ensure survival and success across the full spectrum of possible futures. Instead of betting on one scenario or one hedge, the wiser path is to prepare for all scenarios. That preparation is what transforms uncertainty from a threat into an opportunity, and it is what separates fragile portfolios from durable ones. So here's the unspoken truth. In 2025, gold may not fail because it loses value. It may fail because it fails to keep up. Its shine is being outmatched by adaptability, by evolving risk landscapes. If you want to survive and thrive, you need more than faith in metal. You need a sound, diversified framework built for all weather, not just glorified nostalgia. Thank you